Hello, I'm Jackie Lockie and I'm the Head of Training at the AIC. Today's short session will look at gearing. Our learning objectives for this session will include looking at what we actually mean by gearing, identifying the different types of gearing that there are available, and looking at the things to think about when researching funds with gearing. So what actually is gearing? It's a way of magnifying returns to shareholders. It's worth noting that not all investment companies use gearing, so it's important to look at each one individually. There are essentially three different types of gearing. Firstly, borrowing money from a bank to invest. Secondly, using a capital structure. So I'm talking there about split capital investment trusts with the different share classes and a different defined order of payout. The third way is to buy investments inside the portfolio that are themselves geared. The most popular way an investment company gears up is using financial gearing, and they go to a bank and arrange for a short-term bank loan, normally about 5 to 10 years. It's done on a fixed rate basis and very similar to a fixed rate mortgage that you or I might take out. Let's look at an example. Starting with the left-hand column, you'll see we have an investment company here with 100 million of assets, 13 of borrowing with a net asset value of 87. When we work out the percentages, that gives us a gearing percentage of 15%. Now, let's look at what happens if the total assets grow or fall by 10%. If they grow by 10%, you'll see there that the gearing percentage changes to 13. And if it falls, it changes to 17. Now I just want to show you where I've got the percentage change to net asset value from. Take the gearing 15%, multiply by the increase in assets of 10%, and you get 1.5. That is the extra amount by which the fund moves. So add 1.5 to 10 and you get plus 11.5 if the fund grows, and deduct it from the increase from the 10 to get 11.5 if the fund falls. Our second way of gearing up was structural gearing. Remember, this is via a split capital investment trust where we have different rights and entitlements for the varying share classes. This is the predefined order of payout. If you come across investment trusts that are split capital investment companies and not all of these shares are listed, then just cross out the relevant ones. And you will always end up with this predefined order. As with most things in life, the bank always get their money first. And so if the split capital investment company carries any bank debt, any financial gearing, then that is always taken into account before any shareholders receive their money. So our third part of gearing is investment gearing. So that's what's inside the underlying portfolio. Some examples are Marks and Spencer's and British American Tobacco. They are also geared investments. Investment company managers can buy other investment companies and investment trust shares that may be geared, but remember that there are rules surrounding and restricting the amount that they can buy. It's worth looking and understanding the useful terms surrounding gearing. So firstly, gearing percentage. That just gives us the amount that's actively being employed by the manager at one moment in time. Net cash is a way of expressing how much an investment company is exposed to cash after offsetting cash balances against its gearing. Historic gearing gives us the high and low levels that an investment company has employed over the last 3 years. And the gearing range is a forward-looking measure giving us the maximum and minimum levels that the company would expect to be geared in normal market conditions. So we need to establish which type of share that you're reviewing. Is it a conventional investment company with one share or a split capital investment company? If it's a split, remember the defined order of payout. Is there any gearing in place right now? Can the investment company gear up in the future? And if so, by how much? Review those measures, the gearing percentage, net cash, historic, and the range data. So remember that gearing does increase risk. Think about perhaps considering limits to the gearing to establish limits for clients. That can be useful for compliance purposes. Think about your client's investment time horizon. Can they stand the extra volatility that a geared investment will bring? Remember that most shares in the underlying portfolio are actually geared themselves. If you want to learn more about gearing and other subjects, there is plenty of online training freely available on the AIC website. So in summary, in this session, we have looked at what we mean by gearing. We've identified the different types of gearing and also looked at things to think about when researching funds with gearing. Thank you for watching.